The 2008 financial crisis was the worst economic disaster in modern memory. Its speed and scale were unprecedented since the Great Depression. In the early 2000s, people were buying houses at a record pace. You didn't even need a job to get a mortgage, just being alive was enough. And then, almost overnight, the game stopped. Nearly $19 trillion in household assets evaporated. Unemployment hit 10% and half the value of the stock market vanished. But what exactly happened, and how could such a catastrophe occur in modern times? Let's rewind time to see how a booming housing market nearly destroyed the global economy. The year 2000, the dot-com bubble had just burst and the US economy was slowing down. To stimulate growth, the Federal Reserve cut interest rates 11 times to 1.75%, the lowest level in 40 years. By the early 2000s, the US government was determined to expand homeownership, even pushing for legislation requiring major mortgage lenders like Fannie Mae and Freddie Mac to purchase more loans for low-income earners. Driven by low interest rates and policies encouraging home ownership, the housing market boomed. Home ownership reached a record high of 69% in 2004, and lending standards were continuously loosened to ensure an uninterrupted flow of mortgage loans. And there is no oversight. In April 2004, the U.S. Securities and Exchange Commission relaxed the net capitalization rule, which had previously limited investment banks to a 12-to-1 leverage ratio between debt and equity. With these new changes, any investment bank with more than $5 billion in assets could now use virtually unlimited leverage. At the time, it was believed that banks could manage risk better than any regulation, a fatal mistake. In reality, banks didn't care about risk because they weren't holding these loans. They grouped them together as mortgage-backed securities, MBS, and secured debt obligations, CDOs. Meanwhile, credit rating agencies rely on flawed risk models and are paid by the very banks that created these CDOs. This cycle leads rating agencies to assign AAA ratings to loan packages that are essentially junk. Wall Street is caught up in the fees. Subprime lenders continue to create risky loans. Banks continue to package and resell them, and investors continue to buy. Everyone is making money. The logic of the system is that if you diversify enough risk, it will disappear. The reality is that if you diversify enough garbage, the stench just takes longer to be noticed. Before long, as those junk loans piled up, the whole neighborhood started to stink. The housing boom peaked in 2005. Subprime loans accounted for nearly 20% of new loans. Interest-only loans became commonplace, allowing borrowers to live beyond their means. Meanwhile, global investors couldn't resist anything related to US real estate, which had long been considered one of the safest assets in the world. On the surface, it seemed like the money would never stop flowing, but underneath, small cracks were beginning to form. And then, things were about to collapse. By 2006, the US yield curve inverted, a classic recession signal, and a handful of people on Wall Street began warning that the housing boom was unsustainable. In 2007, home prices peaked and then began to fall. Suddenly, millions of borrowers were unable to repay their loans and defaults skyrocketed. The mortgage-backed securities and CDOs that people were trading turned out not to be as safe as housing as they had thought. Banks, insurance companies, and pension funds holding billions of dollars in these assets began to suffer heavy losses. In early 2007, more than 24 subprime lenders, including New Century and other industry giants, went bankrupt amid a wave of defaults and foreclosures. Mid-2007, two Bear Stearns hedge funds collapsed under the weight of bad mortgage debt, sending shockwaves across Wall Street. Subprime loans accounted for only about 13% of all mortgage loans, but they accounted for nearly half of all foreclosures. As panic spread, the credit market became chaotic. Bear Stearns froze withdrawals, and banks became too afraid to lend to each other. The Federal Reserve was forced to intervene with emergency measures, cutting interest rates and injecting money into the system to maintain the flow of finance. By early 2008, the housing market collapse had fully erupted. About a quarter of subprime loans had defaulted, and millions of homeowners were in negative equity, owing more than the value of their homes. Then, in March 2008, Bear Stearns, one of Wall Street's oldest investment banks, teetered on the brink of collapse. In a last-minute rescue effort, the Federal Reserve orchestrated a sell-off. JP Morgan Chase acquired Bear Stearns for just $2 a share, later raising the price to $10 with a $30 billion government guarantee to complete the deal. As the crisis worsened, the US government took over Fannie Mae and Freddie Mac on September 6, 2008. These two mortgage giants, responsible for approximately half of all home loans in the US, were on the verge of collapse. Therefore, the government was compelled to intervene to prevent a greater catastrophe. However, The worst was yet to come. On September 15, 2008, Lehman Brothers, heavily exposed to toxic collateral, went bankrupt after the government refused to bail it out. This was the largest bankruptcy in U.S. history. The following day, the insurance giant AIG, crippled by mortgage-related losses, was rescued by the Federal Reserve with an $85 billion loan. At this point, the credit market had frozen, and the entire financial system was on the verge of collapse. As the financial world spiraled into freefall, the U.S. Congress hastily passed a $700 billion bank bailout package known as the Troubled Asset Relief Program, TARP, in early October 2008. This was a desperate attempt to stabilize the banks and a clear acknowledgement that the economy was very close to complete collapse. The wave of damage quickly spread to the rest of the economy. The stock market crashed, with the Dow Jones Index falling nearly 40% from its October peak. Credit dried up. This was a full-blown financial panic. Lehman just filed for bankruptcy. This is true. London wants to know if we can still handle the $2 billion in CDS risk. What risk are we taking anyway? We're holding CDOs, squared CDOs, and something called synthetic mezzanine. Those things account for 90% of our company, and now it's all gone. What? Tranches defaulted, swap contracts triggered, everything valued at zero. It's all gone, vanished. Although the crisis started on Wall Street, it didn't stop there. Approximately 4 million Americans lost their homes, and another 4.5 million faced foreclosure or defaulted on mortgage payments. Around 8.7 million Americans lost their jobs, and the unemployment rate reached 10%. The collapse didn't stop at the borders of the United States. European banks, which had absorbed too much U.S. mortgage-backed securities, were also on the verge of bankruptcy. The entire banking system of Iceland collapsed. Global stock markets plummeted, many falling by 40% to 60% from their peaks. And global trade fell by nearly 10% in 2009. What have we learned? First, loosening regulations without safeguards can be very dangerous. The financial industry has too many loopholes and insufficient oversight. Banks and investors have bet on complex financial products like CDOs and credit default swaps without fully understanding the risks. Secondly, the supervisory authorities failed. Credit rating agencies assigned AAA ratings to toxic mortgage bonds because they were paid by the banks, and ultimately they underestimated the risk of widespread default. Third, the Federal Reserve made mistakes. Fed Chairman Alan Greenspan's policy kept interest rates too low for too long and believed that banks could self-regulate. These conditions contributed to the housing bubble, and no one intervened to control it. Ultimately, complexity doesn't equate to safety. Wall Street's quantitative analysts relied on sophisticated risk models, but they underestimated the interconnectedness of everything. When the housing market collapsed, the entire global system was shaken. The collapse of Lehman Brothers was not just one bankrupt company. It was the first domino in a chain reaction that nearly brought down the entire financial system. Following the collapse, the US government and the Federal Reserve intervened on an unprecedented scale. They bailed out banks through the $700 billion TARP program, injecting capital into failing financial institutions. These moves stabilized the system but sparked public outrage. To many, it seemed as though Wall Street was being rewarded for its mistakes. Taxpayers' money had saved the very institutions that had caused the disaster. A wave of protests erupted, and people worried about moral hazard, the idea that bailing out wrongdoers would encourage future misconduct. Simultaneously, policymakers rushed to restart the economy and reform the system. The Federal Reserve lowered interest rates to near zero, and in early 2009, President Barack Obama signed into law the American Recovery and Reinvestment Act, a $787 billion stimulus package aimed at boosting growth and jobs. In 2010, Congress passed the Dodd-Frank Act, the biggest financial reform in decades aimed at strengthening oversight, regularly checking the health of banks, and preventing another crisis. Dodd-Frank established the Consumer Financial Protection Bureau to protect the public and implemented the Volcker Rule to prevent banks from using customer deposits for speculation. Regulators hoped this would ensure a crisis like the one in 2008 would never be repeated. Globally, policymakers are implementing Basel III, a set of international banking rules that require banks to hold more capital and take on less risk. The economy gradually recovered, but the pain lingered. The Great Recession officially ended in June 2009, but for ordinary people, it didn't end there. Unemployment remained high for many years, and it wasn't until the mid-2000s that house prices and household incomes returned to pre-crisis levels. Even the stock market took 6 years to return to its 2007 peak. The scars of 2008, foreclosures, lost jobs, and shattered trust, lingered lingered long after the crisis ended. This wasn't just the fault of a few greedy banks or some unlucky homeowners. It was a systemic issue, a house of cards built on bad loans, fragile trust, negligence, and the belief that home prices would never fall. Many people on Wall Street genuinely believe they've solved the problem of risk, but in reality, they're just hiding it. Financial innovation isn't bad, but forgetting what you're investing in is. If something sounds too complicated to fail, then it's probably too complicated to trust. If you enjoyed this video, please subscribe to see more similar videos.